Right, good afternoon, everybody. Welcome to the latest in the series of Headstar webinars, helping to educate and inform our community. For those who don't know me, my name's Sue Moul. I'm a Portfolio Finance Director working with businesses in the Yorkshire area, and I work with the Headstar team here over in Leeds. Just so you know, the webinar content will be available later this week, either via LinkedIn or via our YouTube channel. So by all means, make some notes, but we will be making the slides available to everybody then. So I'd like to introduce Paul Grace. Paul's going to do an introduction to himself and his business, but we have a long-standing relationship with Paul, both personally via the business, and not wanting to be his PR agent, but actually he's my go-to person for all things debt related. As when I was a full-time finance director and also as a part-time finance director, I think we can't hope to be on top of all the options that are available in the funding market, particularly as those are expanded over the last few years. And knowing the right broker who can give you the best advice for your business and what it needs is pretty important as a finance director. So that's what Paul's going to explain what brokers do and how the market for debt has changed. So on that note, I'm going to hand over. We will have some questions. You can put those in the Q&As and we'll pick those up at the end. Right, Paul, over to you.
Thank you very much, Sue. Good afternoon, everybody. Delighted to be here. So thank you for the opportunity to come along and talk to you all about how to choose the right debt funding to grow your business. I guess what the market is looking like at this moment in time, and also prepare your business and how to talk to your bank or your particular funder. If I just maybe start a little bit about sort of my background and the business's background. I've been in commercial finance now for approaching 30 years. 24 of those were in high street banking, which was predominantly with Clydesdale and Yorkshire Bank. I left there in the latter part of 2019 and started my own debt brokerage commercial finance advisory business February 20, a month before COVID. So not the best of timing, but we're still here 5 years later, and we're running an independent commercial finance business. There's 6 of us in the business. We're based in Leeds, but cover the whole of the north of England. And we've got approaching 100 years banking experience now in the team. So hopefully we know the market very well. I guess our typical client is in the 0 to 50 million turnover space and the 0 to 20 million debt space. We just do bank debt, and we're not involved in private equity or anything like that. But also fair to say we do have networks and links into that sector. And in terms of sort of the products that we source for our clients, it's everything in commercial finance, from invoice finance, asset finance, right through to property. The only thing we don't do is residential mortgages. Directly authorised by the FCA, so we follow all the same rules and regulations that all of the banks operate under. And, you know, we are quite a specialist finance business. So, you know, we very much want to be the best at what we do. And it's quality over quantity in terms of our USP and looking after our clients, and very much having a relationship-driven approach as opposed to funding being a transaction. The market has been pretty buoyant over the last 12 months. So we've just gone through our financial year end. We've managed to increase our business lending source clients by 82%, and that was across 82 deals, which were up 21% in the year. So it's been a very, very busy year for us, and 2025 shows no signs of slowing down. In terms of, I guess, the role of a commercial finance broker, what is a good commercial financer? What does it look like? Well, I think there's 4 graphics on there that I'd just like to chat everybody through. The first one for me is that we should add maximum value at hopefully quite low cost to the client. So we know the market, we know which funders to approach depending on an SME's borrowing needs, hence adding maximum value. Just as the lights have gone out in our office, apologies about that. Here we go. But hopefully at minimal cost. So, we do take the majority of our fees from the funders that we introduce clients to. So hopefully we are relatively low cost. But we do work across the market. So if we don't have a commission agreement with a particular funder and we still think that's the best place for a client to go, we'll go off and chat to that funder and give the client the choice. I guess if you sort of put our model into what I think we do, we talk to an SME, we understand what they want in terms of their banking, debt requirements, and then we go off and chat to 3 to 5 funders who we think would be interested in proposition or providing that debt for that SME or that working capital. So, we save the client going off and talking to potentially 5 or 10 funders who might not have an appetite for that particular transaction. And we do carry, I think we carry a lot of responsibility through the lending process. So our job doesn't stop once we've got the client that approval. We run with that client through the valuation, the security, the KYC, the onboarding that particular bank or funder needs to do their due diligence. So, we do carry that heavy cardboard box right through that due diligence phase and help the client all the way through the funding process. And my last Star Wars graphic is, I guess, Darth Vader and Luke Skywalker there. Might be slightly controversial, this comment, but when I was in banking, I thought I worked in the light side and broken was in the dark side. Having sort of gone to the other side, I now sort of think broken is the light side and banking is the dark side. And that's no negative comment against the banking industry, but obviously operating in an environment where when I was in a bank and I had one credit policy and one risk appetite, that was quite restrictive, where now we can work with client across a number of funders and work with a number of funders to get the best working capital position for that client. So just in terms of a few customers that we've helped and supported over the last few years, Elite Pro Sport, that is a business that provides a lot of Super League kit to the various teams and is now very high profile. Appleton Appliances, if you've ever bought a Wren kitchen, you will have probably bought Appleton's goods that have been supplied into Wren. Clarius are the biggest UK motor afterparts dealer. So if you've ever been in the unfortunate situation where your exhaust has fell off, I can guarantee that you probably bought a product made by Clarius. And another one, Westgrove Group, a large business in the northwest of England who supply cleaning and security personnel into shopping centres. So a few of our clients there, amongst the many that we've funded, spanning a number of sectors. There's a digital marketing client there. There's a care home client. So we do operate across all the sectors in the marketplace. In terms of I guess funding relationships, they are just a few of the funders that we work with. As I said earlier, we are whole of market, we are independent, so we do work with hundreds of funders and really place that client with the best funder according to their needs. And what I thought I might do over the next sort of 5 or 10 minutes is just really run through sort of categorize those in sort of high street, challenger bank funders and all those sorts of things, and just give you a bit more background as to what we're seeing in those sectors and how those banks are operating. So I guess firstly, the high street, which is my old stomping ground. So you'll see some brands and logos there that you recognise. And I guess these are my opinions. But I guess over the last 5-10 years, I believe you've seen the high streets have a real drive towards the corporate world. So the SME market tending to be ignored a little bit. Banks focusing on larger companies turning over 30, 40, 50 million pounds as opposed to the ones at 2 million or those startup businesses. Really trying to take big slugs of debt and sort of banking those corporate clients. We've seen a lot of relationship managers and business development managers removed from the high street. So I guess a lot of ex-bankers like myself have become brokers as we sort of left that world. But it's very difficult, I think, now to potentially walk into a branch and find a relationship manager. or, access those relationship managers, I guess there's been a lot of what I'm going to call bunkering. So, a lot of SMEs have been placed into call centres, or unless you borrow maybe over £1.5 million, you don't get access to a relationship manager on the high street. I think it's fair to say I think the high street have got a very conservative risk-based approach. They tend to be governed by sort of security. Their view on property has really changed over the last few years. So if you wanted to get a commercial investment deal where you're buying investment properties and relying on rental income to service the loan, that's really disappeared now from the high street, unless you are very, very lowly geared, in which case, the high street is still a good option for you. But undoubtedly, the high street still does offer the cheapest source of funding. So if you've got a good balance sheet and, you're quite in a conservative, lowly geared position, low levels of debt, then the high street is still a really good option for you. However, sometimes it is dealing with an oil tanker. It does take quite a long time to actually for them to turn around the decisions. The relationship managers have got big portfolios, so it does take quite a long time for them to come to decisions. And then dealing with security, you're going into various call centres and service centres and things like that. So it can take quite a long time to sort of go through the due diligence process. Challenger bank market is often talked about, so just like to spend a few minutes really sort of running through the various different funders in that sector. So the first one is if you've got potential property security in your balance sheet, or you actually are a property operator, we find the challenger bank market a lot quicker to get credit decisions from. Their speed of service and execution is a lot higher. Some of these funders have portals, so we submit deals directly to the underwriters, depending on their sort of credit criteria and what they're looking for. So we get access to the underwriters and talk to them directly, as opposed to sort of relationship managers who then take deals to credit. I find there's quite, I'm going to use the word obsession on fixed rates with these funders. These funders like you to take a fixed rate in the market as opposed to a floating rate. And that's often because where you are having a floating rate, they will sensitize the interest rate potentially by 3 or 4%. And that means you can't borrow as much. So sort of preference is that you are borrowing on a fixed rate, which can have its advantages if interest rates move up, but of course it has its disadvantages if interest rates come down. But they are looking for ideally clients taking fixed rates, and I guess there typically is a higher rate of lending. So in the high street, where you might be borrowing a margin from 2 to 3%, in this market it might be sort of 3 to 4% over bank base rate. So these are challenger banks. They do typically have a higher rate. And I guess you just have to balance that off against the speed of how the high street operates, and whether you're prepared to borrow that money a lot quicker and be prepared to pay that rate of return. And again, a few of these funders are focused on origination. So you don't tend to be actively managed as a high street bank might do. So once you've done your deal, you might get put into a warehouse or something like that. There's no monitoring of the deal. Sometimes there's no covenants in the offers. It's just purely a debt and origination play. So plenty of options outside of the high street. And again, whereas the high street have really moved away from property type lending, ground up development, commercial investment, buy-to-let funding, all of these funders are open in this space and looking to grow their appetite and really grow their market share in this sector. Moving on to the sort of cash flow finance side of the sort of challenger bank market. First thing to talk about is some regional based funders. So here in the sort of north of England, we've got 𝗵𝗂𝗶𝗵𝗵𝗁. They are heavily promoting the Northern Powerhouse Investment Fund, which is British Business Bank money designed to get out to northern-based SMEs to help them grow, expand, recruit people. Some excellent bankers within those two organisations. Again, ex-high street bankers, a real keen appetite to go out and look at loan proposals. Probably all of these cash flow funders as well have got a greater risk appetite based on projections. So potentially where the high street might look at what you've done in the past and over your shoulder in terms of your last annual accounts or your last management accounts, these funders will look at projections or personal guarantees, which I'll touch on in a minute. Obviously, you've got a couple of fintechs up there as well, such as 𝗿𝗵𝗵𝗵𝗁, 𝗖𝗵𝗵𝗵𝗵 and Funding Circle. Fintech played a huge role in during coronavirus and the 𝗂𝗵𝗵𝗵𝗁 loans, the Corona business interruption loan, getting funding out to the SMEs. Very quick turnaround times, quite cheap cost of funds because they were backed by the government, with the government guarantee. Our personal experience now of these fintechs is that they've become very, very expensive now. So we worked on one a couple of months ago where the client was borrowing at a fixed rate of 20%. Now that's really, really high compared to, high street banks. We don't like recommending clients take loans out at 20% because it is a huge interest burden. But these where these funders are, and they're always taking personal guarantees as well. So your loans will always be backed 100% by a personal guarantee. So again, it's something to be very careful of when you're working with these funders, to look at these personal guarantees and potentially the impact of that. And there are other things called the Government Growth Scheme, which I'll touch on in a few minutes' time, that you can tap into. Northern Powers investment funders, 𝗵𝗂𝗵𝗵𝗵, FW Capital may look for a smaller guarantee, but obviously the fintechs are looking at those higher guarantees. And then I guess when we sort of move on to the sort of asset and invoice finance side of the market, I guess my observations of this sector is there's a real hunger and desire to do deals. So if you've got a debtor book to leverage up against, invoice finance providers are hungry to do deals. It's often cheaper than a bank overdraft facility. These funders will look at the security that your debtor book or your assets in your business will give you. So we've just done a couple of deals where businesses have been loss-making for one reason or another. But these types of funders are happy to look at your debtor book and lend you sort of 85p in the pound in that sort of turnaround situation. And they're also happy to stretch into the sort of non-favoured sectors. So if you're in the construction industry and you go to the high street, the answer is going to be no. If you're in the construction sector, some of these businesses will work with you, maybe at a lower prepayment on invoice finance, but there is access to funding in those particular sectors, where you might not find it in the high street. There's funders on this slide who will just lend against the stock in your balance sheet, but often in an insolvency position, the stock's gone. So you might be paying 3% per calendar month on those types of facilities, which is very expensive. I mentioned a few minutes ago the Government Growth Guarantee Scheme. So that is an iteration from the old 𝗬𝗵𝗄𝗵𝗵 and RLS recovery loan scheme, which were around during COVID, where the government guaranteed X% of your loan facility as an incentive for lenders to lend into the marketplace. Current scheme, Government Growth Scheme, guarantees funders up to 70%. So again, a lot of these funders are using this to get additional funding out on top of, say, a debtor book, for example. So perfect example we've got at this moment in time is we've got a client who will use an invoice finance facility in the next 3 or 4 weeks through one of these providers. We'll also take a loan from one of these providers as a top up. So the funder is probably lending 100% of the debtor book, that extra 15% top up by way of a loan, and that government guarantee just gives them the ability to stretch their risk appetite. So an interesting side of the market to stretch into. And a lot of these organisations have boots on the ground. So where you're seeing relationship managers disappear from the high street, all of these asset-based lenders are hungry to do business and have business development managers across the region. And then finally, we've got some funders up there who are interested in leverage finance, so lending against the cash flow of the business as opposed to the assets in the business. We've got something there called the EBITDA barrier. So high street funders don't particularly like doing what I'm going to call leverage or shareholder reorganisations. If your EBITDA is south of $1 million, it really needs to be north of 750,000 and above $1 million. And they're really focused on that sector just because if something material happens to the business, they lose a client or something like that, and the EBITDA of that business, say, drops to 350, the enterprise value or that worth of that business has fallen. So that's probably removing the sale of that business as sort of the bank's sort of repayment mechanism. So there's some challenger bank funders here who will look at those types of leverage finance deals. Again, they are moving up what I'm going to call the deal ticket size. So some of these now are minimum £2 million funds out of the door, or that £1 million EBITDA. But there are funders out there who will also look at lower EBITDA businesses as well, who can tap into the government guarantee scheme. Some of these as well have asset-based lending arms, so they will do cash flow as well as invoice and asset finance. And again, you can tap into these funders for buyout, buy-ins, employee ownership trust, which we've seen a big drive towards over the last few years. Different way of extracting value out of your business. So we've seen quite a lot of these go through in the last couple of years, and banks and funders are becoming a lot more familiar with them. I guess finally, and I'm not going to touch on this slide too much because I probably don't think it's an audience that we've got on the call today, but happy to talk with anybody on an individual basis. Again, we work with buy-to-let funders, bridging funders, new build ground up property development funders in that side of the market. And again, I think there's a common misconception out there that it's difficult to find funding in this sector. It's not, but it's just moved away from the high street in terms of the banks and funders who are putting funds out into the marketplace. So in terms of, I guess, preparing yourself for funding, I guess it might sound quite easy, but we're sort of amazed at some of the things and some of the situations that people come to us, and sort of the amount of information that they've got ready to approach the marketplace with. So I just thought it'd be useful to again take a few minutes to run through what we think you should be going to the market with, or what you should have prepared for when you come and talk to people like ourselves. So again, the first one, and I know it's science, but 3 years worth of annual accounts, up-to-date management accounts, including debtor and creditor listings. It absolutely amazes me, businesses who don't have management accounts prepared. If you're coming to us wanting to borrow with accounts dating back to say March 24, and you haven't got any up-to-date management accounts, you're asking a bank or a funder to lend on information that's 12 months old. A lot can happen in 12 months, though. Really getting those zero or QuickBook packages in place, or working with the likes of Headstar and getting those management accounts and all that information up to date is vital, because that's what banks are making those decisions on. And again, projections. So, if you're looking to fund for growth, then tell us what the business looks like in the next 3 to 5 years. And again, what's more important is that the assumptions behind it. So if your turnover is going to grow 20% and you tell a bank that's great, but is it really going to happen? Whereas if you tell a bank that your turnover is going to grow 20% because you've just won a 5-year contract with Leeds City Council, they can buy into that, and all of a sudden they know that. Management CVs and structure charts, again, it's something that we always ask for. Really important for the management to understand the skills and the background of the people involved. Any skeletons in the closet, it's always good to bring them out the closet sooner rather than later, because if you leave them in, the longer it goes on, if a bank or funder finds out about it, it's going to work out against you. Again, succession structures in the business. And again, the organisational structure, car ownership, is there a holding company? Are there alphabet shares? Are there non-voting shares? Help the bank or the funder understand these options as quickly as possible, because the easier we can make it for a bank or funder to credit approve your facility, the easier it's going to be all round and the smoother process that you're going to have as well. Again, it might seem rocket science, but do you know why you want to borrow the money and how you want to pay it back? So we have clients coming to us and say, we just want it in case of need. You go to a bank and say, in case of need, what does that mean? What does that look like? So the more we can articulate what you're wanting it for and how you're going to pay it back, the better. And what security you're prepared to offer the bank as well, which is a key. So I guess just elaborating on those 2 points a little bit more. Look at your financial accounts and actually work out what you can afford to borrow is a key thing. And if you can present that to the bank in an articulated way, that's always going to give you a lot of fixes in the box. So a lot of banks will look at EBITDA to look at, so that's the operating profit plus depreciation and amortization. And then they'll take away what a business owner or shareholder needs in terms of salary and dividends and things like that. And banks are really focusing more and more on this, or that challenger bank market. A few years ago, we had EBITDA, and the C stood for coronavirus. So, obviously businesses were impacted by the impact of COVID, and funders were a lot more flexible in adding back exceptional items to improve that repayment ability. That's disappearing in the marketplace now. So, that EBITDA position is sort of really being scrutinised. But, what your operating profit plus depreciation and amortization looks like in your accounts isn't necessarily always the true position. So, again, articulate that to the bank. And the way we do that and the way we look at it, there's always a difference between discretionary and non-discretionary dividends. And I'm just picking numbers out of the air here. But if you are taking £100,000 out as a dividend every year, but you only need £50,000 to live on, if you can articulate that to the funder and show them that through bank statements or income and expenditure statements, they will add that £50,000 back onto your cash flow to service debt. So, it's really important to educate the funder around that. The exceptional costs that you've got going through the profit and loss account, bad debts. If it's a one-off, then there's no reason why the funder wouldn't add that back to improve your cash flow. If you're making very healthy profits and making excess pension contributions, again, you will be able to add that back. Other exceptional items, if you've been on a big advertising campaign in one particular year, tell the funder about that, and you will always. And the funder will always give you the benefit of doubt on those areas. And again, we have quite a lot of clients who say to us, we want to pay it off in the fastest period of time. So we want to pay it back over 10, 15 years, which then squeezes your ability to borrow because your debt servicing costs are a lot higher. What we always say to a client is look to borrow it over 20, 25 years or 5 years, depending on the scenario. Funders should always let you make overpayments up to 10% per annum. So again, use these overpayments in good years to bring your debt to bring your loans down. But in bad years, you might benefit from those lower interest repayments, or you might be able to reinvest that surplus cash flow into your business. And I guess the final thing is, always look at your interest rate sensitivity. So, the bank will do this. So if you're coming along, add a couple of percent onto what you think the bank are going to charge you from a margin perspective, because again, that will give the bank confidence in how you've approached the scenario. In terms of loan repayment periods, the thing called a lesser spotted overdraft, because they're now really disappearing from the banking space, unfortunately. Overdrafts are granted on a 12-month basis, subject to annual renewal. It's only really the high street that offer overdrafts, and as they bunker warehouse clients, they don't want to do the annual renewal. So they're really moving people away from overdrafts onto invoice finance, funding your debtor book. Invoice finance, again, tends to be annually renewable, but some funders will do 2-3 year contracts if you want that peace of mind and that certainty stroke security. Asset finance, typically 3 to 5 years. But again, we're seeing some funders go up to 7 years on bigger deals or assets, especially wheels, trucks, trailers that have got high residual value. Again, commercial mortgages, funders going up to 25 years. Some are now starting to push 35 years. Typically, you'll get 75% of the property value on a commercial mortgage. Again, we're seeing some funders go up to 80% now, so that's going up. Cash flow and leverage finance, again, if you go to the high street, 3 to 5 years maybe. They tend to like to have their money back quicker. There are funders out there who will, again, run the growth scheme guarantee, so the government's guaranteeing 70% of the loan advance, so they'll stretch repayment out to 6, which means you can borrow more. And buy-to-let commercial investment property, again, you will find funding out there 25 years, potentially as well on an interest-only basis. So lots of options out there in the marketplace across all the funders that we've talked about earlier on. And I guess going back to that security, sort of my rough rule of thumb is the stronger the loan affordability or your profit compared to repayments, the less security you should to provide. Funders are always going to look to take a debenture over the company assets, because if anything goes wrong, it allows them to appoint an administrator or work out that position. They're always going to look for charges on property assets if you're lending against property, invoice finance, asset finance, stock. They're always going to take charges over those assets. And I guess this is always a very controversial topic, but personal guarantees used to be a question I absolutely hated asking when I was in a bank. You know, now I can sort of see when a bank or a funder asks for a personal guarantee, you know, if you're not prepared to stand behind the business, then why should they lend hundreds and thousands of millions of pounds into the business? And personal guarantees aren't necessarily there to kneecap a business owner if something goes wrong in the business and sell the family home. It's about making sure that you're going to work with the funder and work through the problems that that business might be going through at that particular point in time, because you know your business best. The bank is not going to know how to run a manufacturing business or a wholesaling business. You're the best person to do that. So if something does go wrong, the bank doesn't really want you giving back the car keys. So that's one way of the bank looking to help you or mitigate some of the risk by taking a personal guarantee. You can insure against personal guarantees. So there is an insurance provider out there who will insure up to 80% of the liability. But again, similar to those fintech, you know, that's one of the reasons to talk to multiple funders, because you can play one against off the other in terms of personal guarantees, amounts, and things like that, really. So again, sort of a good reason to use a broker who can talk to a number of different providers to find you the best deal. And then finally, just what to look out for on loan offer letters. So hopefully all of the above, you've now got your loan offer, you've got the promise of funding. What are some of the things that you really need to look at to make sure it's the right offer for you? First one is, sorry, as the lights have gone off again. So if I just stand up and wave the lights through. We are in an environmentally friendly building. First one is commitment term versus loan repayment period. So some funders will, they provide you with a mortgage that you pay back over 25 years, but they'll only provide a 5-year loan. So in year 6, you have to go back and renegotiate that loan or refinance to another provider. Some funders will give you a 25-year loan commitment and a 25-year repayment period, but they tend to cost a little bit more because the bank can put 25 years worth of capital to one side to fund that facility. Look at your repayment flexibility. So if you're taking a fixed rate and you want to repay that loan in the first 3 to 5 years or during that fixed rate period, you're going to have break fees. So the bank is going to borrow that money on a fixed rate basis for the same period and back to back in the market. So if you repay that loan early, you're going to have early penalties. Again, look at repayment flexibility. If you're buying a new warehouse and you're going to fit it out for the first 12 months, then you get 12 months interest only. Banks and alternative challenge bank funders should be receptive to that. Look at your loan covenants, what and how many. So quite a lot of funders now are doing away with loan covenants because they don't want to have to monitor them on an ongoing basis. But make sure you're looking at it. If they are putting covenants into offer letters, if you breach those, then effectively you're in default, and the bank's got it. The bank's got the right to ask for its money back. So, maybe a maximum of 1 on the profit and loss account, maybe 1 on the balance sheet, or a loan to value against the security value. But you should really be looking to negotiate those loan covenants because you don't want to trip them up as you move forward. And look at restrictive covenants as well. Some banks will not allow you to declare dividends without their prior approval. Some won't let you go out and do capital expenditure beyond a certain pound amount. So, you want to retain the flexibility in your business, do what you need to do to keep your business moving and running. So make sure you negotiate those restrictive covenants to a minimum. And I guess the final thing is it the best offer? So for us, cheapest isn't always best. We always say to a client, when you've got a relationship manager or a business development manager in front of you, what's the best option for you? Who do you get on with best? If you go back to the bank in 6 or 12 months, who do you think is going to be more receptive to giving you that extra working capital, those extra loan funds? And if that's going to cost you an extra 0.5%, for example, that might be the best cost for you. Because 0.5%, when you boil it down into pounds and pence, might not be a huge amount of money compared to what you can do in terms of increasing your profitability moving forward with that particular business, or new product expansion and all those sorts of things. So with that, I'll pause and sort of hand back to Sue for a Q&A, if that's okay.
Thank you, Paul. And as usual, I've learnt something during that presentation. I've heard a variety of that a few times, and it's always interesting. So thank you for that information. So the Q&A box is open now for anybody who wants to type in some questions, and I'll try to pick those up. I have got a couple. So you mentioned earlier on, Paul, about sort of typical fees and how that's usually a combination of the client paying and you getting commission. So without divulging anything confidentiality, can you give us a sort of rough range for what the sort of percentage fees would be on a typical lend?
Yeah, I guess it really depends on the sort of size of the loan request and what type of loan request it is, whether it's a bridging loan or a commercial mortgage. You will tend to find a high street funder would charge an arrangement fee of around 1.5%. And because of the volume of business we give to them, they would typically pay ourselves 0.75 to 1% of that. So probably half to 2/3 of that fee. And that's at no additional cost to the client. So if the client went direct, they'd probably get charged 1.5. It's just the amount of volume that we get and introduce to lenders that we get that commission. Some funders pay us a 1.5. Some funders pay us 2, depending on the type of transaction. Again, on a big transaction, we might just accept the commission that bank is giving to us. On a £200,000 or £300,000 facility, we might ask the client for a fee on top of the commission as well. It's just very much circumstantial driven. Client needs, if it's a repeat business client who we're on our fourth or fifth funding transaction with, then obviously we will try to be as competitive as possible with that particular client.
Yeah. And so as FD, should we be asking brokers how much commission they're getting off the deal? So we've got complete transparency. Is there any reason why we shouldn't have visibility around that?
No, it's not. It's an interesting world because we've always been fully transparent with our clients. So, we always enter into a terms of business with our clients so they understand what commission we're receiving from a funder and any potential charges they might have to pay. So that gets agreed up front before we do anything, and we confirm that at the back end as well in sort of a suitability report to them. There's a lot of noise around the car finance sector at the minute because motor dealers have been taking commissions from funders and not been disclosing them in the car finance sector for a number of years. So we're actually moving into a world now where funders are disclosing what brokers get anyway, but it's sort of business as usual for us. So, we will always disclose up front what we're earning, what commissions are payable, to the client because they need to be happy with that. And again, we will do that when we get loan offers as well. So, we're not going to prefer a funder who pays us 1.5% commission to another funder who pays us 0.75. All that information is presented to the client, and ultimately it's the client's choice, which funder they want to go with.
Yeah. Okay. Thank you. And I suppose that early in my career, it was drilled into me that you should always try borrow money when you don't need it because it's easier to get and it's cheaper. But then obviously, when you really need it, you can't borrow, or it's very expensive. Where's the balance in that approach then of getting relationships with lenders and making sure you've got access to finance when you need it?
No, I mean, I think you're absolutely right. I mean, there's the phrase, and it goes back to that pig and the piggy bank that, a bank will give you an umbrella, but as soon as it starts raining, they'll take it back off you. So, having access to finance or pre-approval, is great because you've got certainty there of knowing the bank or the challenger bank funder is going to support you in that funding and what you want to do. If you have a particular bad year, everybody tends to look at the last year as being a normal year. So if you have a bad year, that might reduce your debt capacity or your ability to borrow. There's various different ways to get around that. If that bad year is explainable, you can look at a 3-year average to mitigate your last 12 months. You can explain it away. But certainly, going and borrowing and having those funds available is a good thing. I guess you sort of have to counteract that sometimes now where pre-approved facilities, if you're drawing it by a loan, then you're going to be paying interest on it straight away and you've got the capital to repay on it straight away. If it's a committed facility, then the bank might put a non-utilisation fee through to you if you're not using that facility. But if you're happy to pay that non-utilisation fee, then why not? Because you've got the certainty of and proof that you've got that money there and available for you. Again, there's also things like, if going back to the invoice finance facility, those sorts of funders will always lend you 85-90% of your debtor book. So as your debtor book grows, they'll always put more and more working capital into the marketplace for you. So there are a number of options to look at part of that.
Yeah. Okay. Thank you. And then you talked about what things to get ready ahead of applying for funding and making sure all the skeletons are out of the cupboard. What things can go wrong at sort of late on in the process that can spoil a deal, and what can...
Yeah. So I guess if it's property related, then the funder's always going to want a valuation. So we always typically find that people have an overinflated opinion of what the property is worth. So it's important to get the valuation done as early as possible. We often sort of engage valuers earlier in the process and get a desktop valuation. So we go to the funder knowing what a property is going to value at, so there's no surprises further down the line. You'll be amazed at the number of people who try and hide bad credit or counter-court judgments or bankruptcies. They think that banks won't see it if they drop an address off a Equifax credit search or things like that. But, if the business has gone through an insolvency event, 5-10 years ago, let's talk about it to the funder. Let's give them a reason why they should get comfortable with it. Let's take them on the journey. So that sort of stuff does tend to come out of the woodwork quite late on. Funders will more often than not want to see management accounts produced towards the end of a transaction. So if something gets approved in March but doesn't complete until September, they're always going to want to see those accounts nearer the time. So if the business has a downturn, you're at risk of losing that funding, which is sometimes why the challenger bank market is attractive, because the funds can get drawn quite quickly. I guess the other one which we're seeing at the minute quite a lot is lethargy as well. So, owner-manager businesses sometimes, dare I say it, procrastinating on decisions and not coming off the fence. So, we've got the funding agreed, but takes a bit of traction to get things going and really moving. And again, I guess I'm sort of just thinking back to the property side of things. Banks will always do the due diligence on property through solicitors. So, is the title of that property okay? Is there any contamination? Are there any environmental issues? Energy performance certificates is a real hot potato at the minute with the drive. So I'm going to get this wrong, but I think if your property is a D or worse, or it might be an F, you're not going to get funding because it can't be sold. So where are you on your energy performance certificate journey? Bank's always going to look at fire risk assessments. Is there any asbestos in the property? So it's really getting your house in order early on, just to make sure you've got all those I's dotted and T's crossed.
Yeah. Okay, thank you. Somebody's asked a question about the sort of admin aspects of different sorts of funding, and I get where this is coming from, because a lot of the funders want us to have invoice financing, but actually there is a cost, an admin cost of having that facility, isn't there? So how does that help you decide which sort of funding to go with? Is that part of the decision-making process?
Yeah, I mean, I guess some of what we do is, I guess, is probably our intellectual property. So when we understand the borrowing proposition, we'll know how to present it. Is it best invoice finance? Is it best overdraft? Is it best on a loan basis? Invoice finance does have an administration cost, sort of a percentage of the service charge, so can be a little bit more expensive, but again, it tends to be a bit more flexible. So again, for me, does that cost give you more flexibility to draw funding down? So, hypothetically, if you've got £1 million invoice finance line and the funder's going to let you draw 85% of that, you've got 850,000. You could go off and buy £300,000-400,000 worth of stock with that money if you've got headroom availability. If you knocked on the bank's door for that, they're more likely to say no. So it gives you that flexibility and availability. Invoice finance used to be considered sort of the product of last resort if you were desperate for cash and the last funding line available. It's a lot more well received in the marketplace now, because it just gives you that much more flexibility. But it's down to the SME and the business owner whether they want that flexibility vis-a-vis the cost.
Yeah. Okay, thank you. And then I think finally, really, it can take a long time, can't it, to get these things approved? What can you generalise about if I ring you up today and we had all the information available, what sort of timescale we'll be looking to drawing down funds?
Yeah, so again, it depends on the transaction. If it's debenture only, there's not a huge amount of due diligence required. If it's invoice finance, there's no, again, that's what I'm going to call paper security, debentures, charges over the debtor book. You can get that deal done probably 4 to 6 weeks, sometimes quicker. On a property deal, if you're going to go to a bridging lender, fastest we've got done is 3 days. We did one over Christmas in 2 weeks. Probably say on a bridging transaction, 4 to 6 weeks is the norm. On a trading business deal where you've got a factory or a warehouse, more often than not, the bank are looking for you to move your transactional banking to them as well. Probably 2 to 3 months, I would say, in that space. I guess the one tip I would say is that always use a good solicitor. We find the biggest inhibitor to deals, and solicitors on the call today, is the proactiveness of a solicitor.
Yeah.
If you've got a solicitor who will catch the hot potato and run with it and know what a funder wants, it's so much easier to get your funding across the line sooner rather than later. I mean, we've got a completion today, and we first met that client in May 2023. It's taken 2 years to get the deal across the line for a whole vast of reasons, not wholly solicitor related, I hasten to add. But it just shows you how things have changed, and there is a lot more diligence done now on property, EPCs, asbestos, things like that, which do tend to hold up transactions. If it goes beyond 6 months, your valuation's likely to go out of date, so you're going to need to get the valuer back out to re-inspect it. So, it's about project managing it. And again, I go back to one of my first slides. We've got a great team in our back office who project manage deals with clients, talking to solicitors, talking to funders, understanding what we need to get done by when to get the deal done.
Okay. Right, well, I think we're all done on the questions. So I just want to thank Paul again for joining us this lunchtime, and for everybody who joined us on the webinar. And just a reminder that the content will be available. You'll be seeing how to access that via LinkedIn and email. So thank you very much, Paul, and hope everybody has a good afternoon.